My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. Today our special guest zooming in from California, very experienced real estate investor, Brian Burke from Praxis Capital. Knows a lot about multifamily real estate investing. That's what he and the company have done for decades. Then they kind of saw the writing on the wall a few years ago, got out of it, sounds like at the nick of time, and have kind of pivoted things towards a very, very interesting asset class, and that is senior housing healthcare. So that's what I'm going to be talking about today with Brian Burke. Welcome to the show, Brian.
Thanks for having me here, Dave.
So I kind of gave a little overview, but maybe you can give us a snapshot of you and your company and what you invest in as of this recording, which will be coming out at the beginning of 2026.
Yeah, our current focus is, as you mentioned, it's in senior housing healthcare, which is assisted living, memory care, and skilled nursing. It's different subclasses of senior housing. We made this pivot early in 2025, seeing that senior housing had a real demographic and supply problem. And that was that the population of the U.S. is getting older, and there's a shortage of assisted living, skilled nursing, and memory care, and nobody's building any new ones.
Interesting.
So it seemed like a very interesting time to get in at the bottom of a cycle that has a lot of runway left. And incidentally, an article just came out the other day saying that senior housing is the top performing asset class in all of commercial real estate now. So I think the choice turned out to be a pretty good one.
Great. So what does the portfolio currently consist of?
Well, right now we've got 19 properties in 18 cities in 4 states with about 1,500 beds of a variety of different acuity levels across independent living, assisted living, skilled nursing, and memory care. Vintages ranging from 1980s built to almost brand new. So it's a very good portfolio that we've built so far, and we've got a lot more right behind it that we're getting into contract on, and some that we're about to close on.
Very, very cool. So sounds like kind of smaller facilities, or what's kind of the average bed size for these facilities?
Yeah, the averages range between about 50 beds and 150 beds. We don't buy smaller properties independently, but we'll buy them in a portfolio. So if we're going to buy a 50-bed facility, we probably wouldn't. But if we bought 10 of them at once in one transaction for 500 beds, that we would do. And that's exactly how we've acquired, the smaller facilities that are in the portfolio.
So maybe explain for those of us that don't really know the difference between assisted living, memory care, and skilled nursing. What do those different facilities kind of look like?
Yeah, so there's a whole, acuity level spectrum in senior housing, and there's another property that's called a CCRC. And I'll explain a CCRC because it'll cover and encompass all of the others, because what a CCRC is, it's a continuing care retirement community, and it's designed for someone who can still live on their own, to have an apartment unit to live in, and that's called independent living. And then as they age and their needs become greater, where maybe they might need some assistance getting up or bathing or whatever, then they can move to an assisted living unit. So that's what assisted living is. There's nursing care that's provided for, just general assistance type stuff. And all of these different acuities would have things like, meal plans and activities and all that sort of stuff. But then working your way up the acuity ladder, that you may need memory care, where, for Alzheimer's, dementia, different types of things. So memory care is another subset where generally it's in a bit more of a secured wing of a facility, so that people don't wander off. And then skilled nursing is when they get to that point where they need basically 24-hour care. then the skilled nursing bed would be appropriate for somebody that fits into that category. So there's kind of a whole spectrum of living as the aging and acuity gets up there.
Okay. So you talked a little bit about supply and demand at the beginning here. What is it that you guys like so much about this senior healthcare investment? What are the big benefits of this for you and your investors?
Well, there's a few actually. One is that the sector entered into a steep down cycle at COVID. The pandemic literally killed the patients inside facilities. And, for those patients that survived, they may have been pulled out of facilities by family who were afraid that they may get the virus and were afraid for their safety. So the entire industry really got crushed. And now you're coming out of that period where facilities are filling back up. The pandemic is behind us and confidence has increased and policies and procedures have improved and all that sort of stuff. And
plus you got the baby boomer boom,
100%. You got 80 plus population is expected to more than double in the coming years, and all those people will need a place to go if they need assistance. And so there's a lot of demand for this, but there's nobody building anything really. I mean, there's not a lot of construction in this sector. It's hard to pencil out new construction. So kind of the thesis behind the investment is buy something at the very bottom of the cycle that has a strong demographic tailwind, and you can do extraordinarily well. And we've done this before. We did it in the great financial collapse in single family housing. We got behind a massive tailwind and had an incredible result. We did it in multifamily when multifamily was coming out of the GFC. And rode that all the way up through its up cycle. And, here we are again with the opportunity to be involved in another sector of real estate at the very depth of a cycle that has a strong tailwind behind us. So we're really looking forward to the strategy.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah, most definitely. It sounds very, very appealing. But nothing is ever all sunshine and roses, Brian. So what are some of the not so great parts of this business model?
Yeah, the difficulties are, and there's a lot. One is that there's a different barrier of entry calculus to this, where, in multifamily, anybody can do a weekend boot camp and then they're out, all of a sudden they're multifamily investors and they're out buying multifamily, and, they were competing against us to buy multi when we were buying it. And it creates
there might be a few less of them these days.
There's quite a few less of them. They didn't survive it. At least some number of them didn't survive it. So, so that's a bit of an issue in some classes of real estate, but this one is a little bit tougher. There's more operational complexity. There's some things that are very specific to senior housing that you don't see in other asset classes, which make it tricky. So it's just not something to get into after a weekend boot camp. I would never have attempted to get into this sector if I didn't have the good fortune of being able to recruit a 20-year professional that's done nothing but senior housing to join our team and walk this procedure through for us. So that's one of them. The other is that, the operational complexity, as I mentioned before, you have things like, staffing challenges. And, if you thought that hiring a maintenance guy and a leasing consultant and a manager for an apartment complex was tough, try hiring, 20 nurses and a nursing supervisor, a scheduler, a marketing person, and all of the associated staff that goes into operating one of these facilities is extraordinarily operationally complex. We've decoded that by bringing on and partnering with operators who do nothing but that component, so that we don't have to do it. But that is another challenge to this side of the business. And the other challenge is that the financing is a lot different than you'd find in multifamily, but that's both good and bad. It's kind of a downside because it's new and different, but it's an upside because the financing for it, once you can see it all the way through, is absolutely incredible and far superior to the financing packages that we get in multifamily. So it's kind of a challenge, yet that challenge breeds an opportunity.
I was going to ask you this, Brian. So it's you get operators to come in and run the individual facilities. So are they kind of subletting? Are they leasing the property from you and running the business, or how does that side of things, like, is that kind of how that works?
That is. You're exactly right. In fact, we're triple net leasing to the operators. Okay. So for us, we're real estate guys, right? We're not patient care guys. And so we want to partner with absolute best in class regional operators that have a footprint and experience in the markets that we're in. And in fact, really the operator is everything for us. So the real estate is secondary. So we approach this business completely in reverse from the way you might approach any other real estate investment. For example, apartment buildings. You might say, okay, we want to be in the apartment building business and we want to own apartments in Central Florida because there's an influx of population and this reason and that reason and rent growth and yada, yada, yada. And then so you go and you find property, and the next thing you do is you go, okay, we found this great deal. Now we got to go find a management company to run it for us, right? That's how a lot of multifamily operators function. We approach the business completely differently. We approach it from operator first. Who are the best operators out there that we want to work with? Where are they located? And where can we find facilities that they either already run or would like to add to their portfolio? Mm-hmm. And that's how we source real estate.
So the comparable multifamily would be find the really good property management companies and go buy multifamilies that they can manage. That would be kind of the comparable there. Is that what I meant?
Yes, exactly. Or maybe ones they're already managing. Yeah. That's right. Yeah. So that's how we're approaching the business. And then we exactly as you said, we triple net lease the facility to those operators so that we can stay as real estate guys, which is our core competency. And they can operate as operators, which is their core competency. And we don't, get in the middle of and interfere with their business. That's what they're good at. And it helps to kind of segregate the liability too.
Saves you a nightmare of learning that whole side of the business and recruiting nurses and manage all that stuff. There's no way in hell I'd want to touch that with a 10-foot pole. I can imagine that'd be a nightmare. So yeah, very smart. Very, very smart. So that's what you're up to. As we're recording this, it's going to be the beginning of a new year. What do you guys have on the books for 2026? What are the big exciting plans?
Well, probably more of the same. We launched a $50 million fund in the second quarter of 2025. We've raised about $45 million for it already, and so we've got a little bit of an opening left to finish up and round out that fund. In 2026, maybe we'll even oversubscribe it, which we can do. We have 2 property portfolio we're getting ready to close on that may happen in early 26, or it could even potentially happen before the end of this year. We'll just have to see. And then we're about to sign up another almost $100 million portfolio of assets that would close in the first quarter of 2026. And we've got a few more properties and portfolios that we're in discussions with sellers right now. So it's going to be a lot more of the same. I don't see us diving back into multifamily in 2026, maybe in 2027. But I think for 26, it's going to be focused on the senior housing strategy.
Well, it makes a ton of sense. Brian, if people want to connect with you and find out more about what you guys are up to, where should they go?
The best place is our website. Our company is Praxis Capital, and the website is praxcap.com. which is praxcap.com.
Brian, thanks for being on the show.
Thanks for having me here.
All right, everybody. See you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.